I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, president of InsideTrack.com. He's speaking to us from the Chicago area. Eric, welcome back to the show.
Well, thanks for having me back, Jim. Pleasure to be here.
Last time we talked, it was Brexit. Some of the latest numbers from the UK, though, show that business hasn't been hurt and unemployment numbers there are below 5%, first time since 2005. And unlike other countries like the US and Canada, where once your employment insurance runs out, you're technically not unemployed anymore. In the UK, because they have a continuous welfare system, they know actually how many people are really working. So those numbers are real. And do they kind of fly in the face of all the panic that there was right after the vote?
Well, I think that's a perfect example of the often disconnect between fundamentals and technicals, particularly at important turning points in the market. And it's my contention and the contention of most technical analysts, and by technical analysts, I'm referring to those that look at charts, look at price data, and make their decisions and their conclusions based on that rather than the latest economic number or interest rates or other fundamentals. But the technicals usually lead the fundamentals, and often the fundamentals don't become obvious until the culmination of a move. And the action of the British pound has been a perfect example of that over the last couple years, and then right leading into the vote on Brexit. I have been publishing for the last couple of years analysis on these longer-term cycles in the UK and in the British pound, and they were coming to a head in 2016, 2017. More specifically, I documented an uncanny 8-year cycle where at each 8-year point, the British pound got pummeled. And that went back to 1960 and 68, 76, 84, flowed all the way forward to the last time being in 2008, when the pound lost 35% in 14 months. And I was looking for another sharp sell-off into at least mid-2016 as the next phase of that cycle. And there were a lot of other technical indicators that were showing this to me. And so the Brexit vote was just a perfect confirmation of that. But if you're waiting for a fundamental like that to suddenly get bearish on the British pound, you're so late in the game, and often those are the traders that are selling the bottoms and buying the tops. So that, and it also goes with the old adage of either buy the rumor, sell the news, or sell the rumor, buy the news, depending on what the rumor is. And so selling the pound leading into this vote, with all of the technical analysis saying that the pound should drop to at least 130 and maybe a little bit below that. But then once the fundamental news comes, that's usually the culmination of a move because you get all the remaining sellers, those that are just going on the headlines. They jump into the market, or in this case, jump out if they're not selling short. They jump out of the market, and then there's no one left to drive prices any lower, so the buyers start to come back in. And it doesn't surprise me that there are underlying fundamentals that most economists and fundamentalists would think, well, this should be bullish for the pound. It doesn't matter. It's what market perception is, and it's what the price data has been showing. And so it kind of fits together well that you're getting news that, oh, things aren't quite as bad economically for the British pound, but there still is a big perception problem there, and there's going to be continued uncertainty until they even get to a parliamentary vote on this referendum, and the markets can finally digest what is going to happen looking forward.
One of our regular correspondents, Martin Element, is in London, and he was telling me that the business people he was talking to were very optimistic about the future, saying they believe Brexit gives them all kinds of new opportunities because they don't have to go through the heavily regulated European Union.
I could certainly see that because, not that I'm an expert on British economics, but just the mere fact and the simple correlation that moves and decisions like this may be perceived one way by the traders, and traders may continue to keep applying pressure on the British pound and ultimately Britain equities and whatnot. But yet it may be a decision that for the average man on the street actually has a lot of benefits. And it's like any transition too. When you shift from one known to an unknown, a lot of people, the perception is that the devil you know is better than the devil you don't, and so they really cling to the old guard, and there's a very volatile time in the markets during a transition like that. So it could very well be a positive looking forward. But, everything I've read and heard too, it would be 3 to 5 years before this whole thing really completely plays out. First with a parliamentary vote that would have to make it official, then with how the EU structure is set up, or the Euro structure, I should say, and the transition time that's allocated by law into that. So the actual realization of that expectation is probably several years down the road, and there's a lot of other things that are likely to happen in the markets long before then, to where people may be looking back at Brexit and just kind of yawning.
Any shockwaves from the attempted coup in Turkey?
In the markets, I have not really seen much of that. It was very convenient from a market perspective that pretty much the whole thing transpired over the weekend. I believe it was Friday evening here in the States when word of the attempted coup started hitting the news wires. And, I think the markets may have happened a little before the markets closed and got a little bit of a reaction. But by the time the whole thing transpired, from start to end, it had pretty much gone back to the status quo, more or less, by the time markets opened on Sunday night and Monday morning. So we didn't see shockwaves there. I think that the general consensus is that this is going to give more validation or more justification, I should say, to Erdogan applying more executive powers and consolidating power more. And so I think that the shockwaves are more slow steady moving things that are likely to unfold over the next 6 to 12 months. And as you begin to see them unfold, that's when I think the markets could get a little more unnerved and look back and pinpoint this coup as the watershed event.
We'll have more with Eric Hadik right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Eric Hadik. Eric, one of the analysts I saw the other day on TV was explaining that he thought silver prices would decline over the second half of the year. How does that play out on your charts?
That would actually fit pretty well with the with the general outlook I have had for this 3 to 4 year period starting in late 2015, early 2016. I know we've discussed it numerous times in past discussions, but my outlook for leading into 2016 is that 2016 would be what I was terming the golden year, and I specified or clarified that by saying I didn't think that gold was going to go into the stratosphere during 2016, but rather it would give the first convincing and sustained advance that it had seen since 2011, and that would be a precursor to things to come in 2017, 2018. And I went on to explain back in late 2015 that I thought we would see an initial advance for the first 6 months of 2016, and then a pullback to a secondary low in late 2016. Now that's general time frames that advance into mid-2016. I also started to hone that a bit and explain why the third quarter of 2016 was the likely time for that 3 to 6 month peak, and the fourth quarter being when I thought we would see a secondary low, which means it should be higher than the low of late 2015. And that cycle analysis was also corroborated by the technicals and the specific trading signals that were triggered in late 2015. At the time, in my publications, I was explaining to readers why in mid-December of 2015, gold and silver triggered a 1 to 4 week buy signal, triggered a 3 to 6 month buy signal, and triggered a 6 to 12 month buy signal, all in the same 1 to 2 week period. And that was a pretty powerful signal to me, but it also gave me a general idea and some confirmation to what the cycles were already expecting, and that was that we would see an initial 1 to 4 week rally, a overall 3 to 6 month rally, and that it could even go a bit beyond 6 months as part of that overall advance. But it would be in stages. So gold and silver have filled that nicely. In fact, there is a trigger point that I published in my last weekly relay where it would be time to start getting out of some of the long positions that were triggered back in December. And gold is very close to that trigger point now. So it would certainly fit with that general theme of some pressure on silver, at least, in the second half of 2016. But like I said, the markets get more specific and more precise than that, so I need to see some corroborating signals to tell me, okay, a 3-month top or longer is intact, and that gold and silver are ready for some consolidation. But all of that is still within the overall context of 2016 being the first big advance, and then 2017, 2018 being an even larger move higher in gold and silver.
Would it be a better move to go into gold and silver miners or bullion?
That is going to come down to specific timing. I have explained and documented numerous times over the last decade or so, and I really kind of reiterated this discussion in late 2015, that there is almost always a 6 to 9 month lag or divergence between when the metal bottoms and tops and when the stocks, the miners, bottom and top. And that even alternates sometimes, one before the other, and then vice versa at other turning points. So it would come into the timing of when that occurs. And one of the things that I've warned too is that reinforcing that general theme for the metals, I thought that late 2016 would be the time when overall equity markets would have the best chance of seeing a more sustained decline. So if that does materialize, I've been talking about, I thought that the markets would have a 15 to 18 month period of just kind of volatile swings all within a big trading range, kind of like the stock markets saw, or at least the Dow Industrials saw back in 2000, 2001. But then towards the end of 2016 is when a lot of other factors would start to turn more negative, and there was a better chance of a more sustained sell-off in equities. The reason I mention that is that would have a big influence on whether you want to be in, say, gold the metal or gold stocks. Because if that materializes, if equity markets do see a more significant drop in the end of this year, and then I'm expecting it to carry over into 2017, that would weigh far more heavily on gold stocks than it would on gold the metal. And in fact, gold the metal would probably rally on a flight to quality or a safe haven status. So that's part of the reason you also see this 6 to 9 month lag too, is that it often has to do with the overall equity markets. And so you may see a sharp sell-off in the equity market that weighs on the miners, but at the same time, gold is already showing signs of strength. We even saw that in the beginning of this year, where gold set its price low in early December, and something like the XAU index didn't bottom until after mid-January. And sure enough, that was right while stock indices were seeing a sharp sell-off from mid-December to late January that weighed on the miners. All the meanwhile, gold was starting to rally. Then once the equity markets bottomed out, that took off that big negative pressure on the miners and allowed them to start to catch up with gold and have a bigger move. So again, that comes back to the timing of when you're looking to get into either one of them, whether I would choose the metal or the miners.
The Dow Industrial Index has gone up for the past 2 weeks. Is that sustainable?
I don't believe so, and it fits very nicely with cycles we've talked about over the last 6 to 9 months. When we were coming into and immediately after the late January lows, I know I was discussing with you this 5-month cycle that had been governing recent moves in the stock market. And you could see it most clearly when you look at the time span between the late August and the late January lows, both of which were the culmination of a quick, sharp sell-off in global equities. And I was looking for another important low in late June, 5 months after the late January low. Well, the Brexit vote and the reaction after Brexit provided the perfect confirmation, but also culmination of the selling in equities, and it set the stage for the bottom that I was looking for in late June. And even before that took place, I was explaining to my readers why I thought we would see a subsequent rally into July 19th or 20th. And there's a lot of factors coming into play then. It could stretch a few days past that, but that was, I was looking for at least that 3-week rally from late June into July 19th or 20th. And at the time, I had an initial upside target when the Dow was hitting support at around 17,100. The upside target was 18,600 to 18,700 in the Dow Industrials. And so they are nearing that price target. At the same time, they're entering this timing objective. So I'm looking at the next couple days. My radar is very heightened awareness to see if I get any signs of a top and reversal lower. And that's the key too, is even when I do this analysis, come up with these very specific targets, I need the price action at that culmination point to confirm the expectations. I need to see some specific reversal patterns that I use to say to me, okay, we do have a top, we do have a sell signal, now it's time to start looking to the downside again. So we're coming right into that, and there are some specific things that I need to see in the next few days to see if this is the culmination of a quick surge after the Brexit selling.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, president of InsideTrack.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.